Here's something nobody tells you about money. The price of it changes. And right now, that price is expensive. Really expensive. And it's staying that way. In early 2022, you could borrow money for basically nothing. A mortgage cost you 3%. Car loans were cheap. Credit cards were, well, credit cards, but still. The Federal Reserve had interest rates near zero. Money was free. Today, completely different world. The Fed has rates above 5%. Mortgages are pushing 7. That cheap money? Gone. And here's the uncomfortable part. Everyone thought this would be temporary. A quick spike, a brief correction, then back to normal. But it's been 3 years, and those rates aren't coming down the way anyone predicted. So what happened? Why is borrowing money still so expensive? And why does every expert who said rates would drop by now look like they were reading the wrong script? Let me explain it like you're 5. Except you're not 5. You're just someone who wants to understand why the financial world suddenly got a lot more expensive and shows no signs of changing back. Let's start with what interest rates actually are, because most people know they exist, but not really why. Imagine money like water. When there's a lot of it flowing around, it's cheap, easy to get. You turn on the tap, water comes out. That's low interest rates. Money is abundant, so borrowing it costs almost nothing. But when water gets scarce, that's when you start paying. High interest rates mean money is expensive. There's less of it to go around, or the people controlling it decided you need to pay more to access it. The Federal Reserve controls that tap. They're the central bank of the United States, and their main job is to make sure the economy doesn't overheat or freeze solid. They do this by adjusting interest rates. When the economy is sluggish, they lower rates. Cheap money means people borrow, spend, invest. Businesses expand. Everyone feels rich. Growth happens. When the economy runs too hot, they raise rates. Expensive money means people borrow less, spend less, things cool down, inflation slows. Simple, right? Except nothing about this is simple anymore. In 2020, the world shut down. COVID hit. Businesses closed. People stopped spending. The economy seized up like an engine without oil. So the Fed did what it always does in a crisis. They dropped interest rates to zero, and they printed money, trillions of dollars. They flooded the system to keep everything from collapsing. And it worked. For a while. People got stimulus checks, unemployment benefits expanded, stock markets went up, housing prices exploded, everyone started spending again. Demand came roaring back. But here's the problem. Supply didn't. Factories were shut down, supply chains were broken, ships sat in harbors, chips disappeared, lumber prices went insane, and suddenly, everyone wanted to buy things, but there weren't enough things to buy. That's inflation. Too much money chasing too few goods. By 2021, prices were climbing, not just a little, a lot. Groceries cost more, gas cost more, rent skyrocketed. Everything got more expensive. And the Fed? They said it was temporary, transitory, they called it. Just a blip. Supply chains would fix themselves, inflation would cool off on its own. They were wrong. By 2022, inflation hit levels not seen in 40 years. 9%, nearly double digits. Your dollar was losing value every single month. So the Fed panicked. Not publicly, they never panic publicly. But behind closed doors, they realized they had a massive problem. They had flooded the economy with cheap money, and now that money was burning a hole through everyone's wallet. So they did the only thing they could. They raised interest rates fast, faster than they'd raised them in decades. March 2022, rates go up a quarter point. May, another half point. June, 3/4 of a point. July, another 3/4. In less than a year, the Fed took rates from 0 to over 5%, the fastest tightening cycle in modern history. And everyone assumed this would work quickly. Kill inflation, bring prices down, then rates could drop again and we'd all go back to cheap money. But that's not what happened. Inflation did slow down. It peaked in mid-2022, then started falling. By 2023, it was down to 4%, then 3%, getting closer to the Fed's target of 2%. So why didn't rates come down? Because inflation didn't die, it just paused. See, the Fed has a target, 2% inflation. That's the magic number. Low enough that prices feel stable, high enough that the economy keeps growing. It's the Goldilocks zone. But inflation has been stubborn. It keeps hovering above 3%, just high enough that the Fed can't declare victory. And here's the thing. Inflation isn't just one thing. It's a symptom of a dozen different problems happening at once. Housing costs are still rising. Rent isn't coming down. Insurance premiums are climbing. Wages are up, which sounds good, but that means businesses are paying more, which means they charge more, which means prices stay high. It's a loop, and breaking that loop takes time, a lot of time. So the Fed keeps rates high, waiting, watching, hoping inflation finally dies for good. But the longer they wait, the more expensive everything becomes. Here's where it gets weird. High interest rates are supposed to slow the economy down, make people spend less, cool things off. But the economy hasn't slowed down. Not really. Unemployment is still low, people are still spending, the stock market keeps hitting new highs, GDP growth is solid. By every traditional measure, the economy is fine. So why does everything feel so expensive? Because high interest rates don't affect everyone equally. If you own a home with a cheap mortgage from 2020, you're locked in. Your housing cost is frozen. You're fine. But if you're trying to buy a home now, good luck. Mortgage rates are double what they were 3 years ago. That same house that cost you $2,000 a month in 2021 now costs $4,000. If you have cash saved, high rates are great. Your savings account actually earns something. Bonds pay decent returns. You're making money just by sitting still. But if you need to borrow, credit card debt is crushing. Car loans are brutal. Student loans just came back. Suddenly, being in debt is really expensive. High rates create winners and losers, and the losers are loud. But the economy as a whole still chugging along, which is exactly why the Fed can't cut rates yet. Let's talk about what happens if they cut rates too early. Imagine you're trying to put out a fire. You dump water on it. The flames go down. You stop. You walk away. Then the fire comes back. That's what the Fed is terrified of, cutting rates too soon, letting inflation reignite. Because if inflation comes back, they'd have to raise rates even higher to kill it, and that would really break things. So they're playing it safe, being cautious, waiting for certainty in a world that doesn't offer any. And in the meantime, money stays expensive. Welcome to the new normal, wherever that actually is.